Welcome back, everyone. It is great to have you back for this new block of material. In our last session, we spent a lot of time exploring the foundational theory of accounting. We went deep into general accounting principles, unpacked GAAP, and studied the mechanical differences between the cash and accrual bases of tracking your books. But here is the thing. Principles only establish the why of accounting. They don't give you the exact rules for execution. Today, we bridge that gap. We are moving from baseline theory to hard statutory frameworks. We will look at how regulatory standards and selected policies turn those high-level principles into real-world, compliant financial statements that corporate markets can actually rely on. Let's get started. Let's look at how this works in India. Financial accounting isn't a free-for-all. It operates under a strict regulatory standard-setting framework. At the very top is the Institute of Chartered Accountants of India, or the ICAI, which is the apex accounting body in the country. To handle the technical details, the ICAI established the Accounting Standards Board, known as the ASB. The ASB's core job is to formulate clear, standardized accounting rules that align with Indian tax codes and the legal boundaries of the Companies Act. Why do we need this? Because without standard rules, different companies would record identical transactions in completely different ways. These standards eliminate those variations so that statements are universally reliable and comparable across industries. Now, accounting rules can't just look inward, they have to adapt to global markets. In our current economy, capital is completely global. Modern businesses routinely look across borders to raise funds or list their shares on foreign stock exchanges like the Nasdaq. If a global investor in New York wants to compare an Indian tech giant like Infosys to a company in Europe, they cannot do it if both companies are using completely mismatched local accounting rules. This reality forced the creation of international accounting standards. Because of this, many multinational enterprises face a dual reporting burden. They must prepare statements under domestic Indian standards and then recalculate them under global formats. This global framework demands a highly standardized, four-part output checklist: an income statement, a balance sheet, a statement of changes in equity, and a highly structured cash flow statement. This brings us to a critical term: corporate accounting policies. By definition, these are the specific accounting principles and distinct application methods selected by a company's management to prepare their books. Why does management get to choose? Because the economic landscape is incredibly complex. A single, rigid list of accounting methods cannot possibly fit every single business type out there. However, management doesn't have total freedom. Their primary choice driver must always be the true and fair standard. The selected policy must provide an unskewed, faithful image of the company's actual financial health. Furthermore, they must follow the rule of substance over form. This means that the true economic reality of a transaction must dictate how it is reported, regardless of what the superficial legal paperwork says. When you open any set of corporate financial statements, there are certain baseline rules called fundamental accounting assumptions. These assumptions are automatically presumed to be active. Companies do not even need to state them explicitly because their acceptance is completely taken for granted. The Big Three are going concern, which assumes the business will survive for the foreseeable future; consistency, which states that policies cannot be changed randomly from one year to the next; and accrual, meaning revenues and costs are matched to when they physically happen, not when cash changes hands. Here is the legal catch: if management breaks any of these baseline assumptions, they face an immediate omission penalty. They are legally required to explicitly state exactly why they did not follow them. Let's look at a concrete standard that is Accounting Standard 2, which governs the valuation of inventories. This standard lays down a golden rule: inventory must always be carried on the balance sheet at the lower of its historical cost and its net realizable value, or NRV. To calculate that cost accurately, you must know what to include and what to leave out. You include the raw purchase price, any non-refundable import duties, and inward transport freight. If you are manufacturing goods, you also add conversion costs, which include direct labor and a systematic allocation of factory overheads. But pay close attention to the exclusions. storage costs, general administrative overheads, and selling expenses can never be added to inventory value. They must be sent straight to the current period's profit and loss statement as immediate expenses. Once you have your cost elements down, how do you track them as inventory moves through the business? This standard allows companies to use specific cost formula tools, primarily first in, first out, known as FIFO, or the weighted average cost method, known as WACO. Under the FIFO logic, we assume the oldest stock items are sold first, which means the inventory left at the end of the year reflects the most recent purchase prices. WACO, on the other hand, constantly recalculates a running average cost every time a new shipment arrives. Finally, remember our rule about net realizable value. If inventory becomes damaged, obsolete, or market prices drop below what you paid, you must apply the NRV deficit rule. You must write down that inventory on an item-by-item basis to its true net value so you don't overstate your assets to the public. Next, let's talk about long-term assets and look at Accounting Standard 6, which is depreciation accounting. Depreciation is the systematic allocation of a long-term asset's historical cost over its useful life, after subtracting its estimated scrap value. It represents the cost of an asset wearing out due to physical usage, technological shifts, or simple time decay. However, notice the exclusions. This standard explicitly does not apply to natural resources like forests, wasting assets like natural gas mines, ongoing R&D expenses, or corporate goodwill. Now, what happens if management decides to change their depreciation policy? Say, shifting from the straight-line method to the reducing balance method. The standard enforces a strict method catch-up rule. You must recalculate the depreciation retroactively all the way back to the exact day the asset was purchased. Any resulting surplus or deficit cannot be hidden. It must hit the current year's profit and loss statement immediately. Let's look at our final major standard for this segment, Accounting Standard 10, which governs fixed assets. A fixed asset is defined as a wealth asset held with the clear intention of being used for long-term production or services, and it is never held for ordinary resale in the course of business. When you first acquire a fixed asset, its initial cost capitalization includes site preparation, delivery, installation fees, and even professional bills like architect fees. But there is a very strict commercial cutoff rule. The moment the plant or asset begins standard commercial production, the capitalization window slams shut. Any expense incurred after that date must be labeled as a revenue expenditure and sent straight to the P&L. Finally, if you appraise your assets upward, those gains must be kept completely separate. They go into a locked revaluation reserve and can never be used to distribute dividends to shareholders. That brings us to the end of our discussion on these regulatory frameworks. You now have a firm grasp on how accounting standards and choice-driven policies create compliance and structure. But as we prepare to wrap up today, let's take a quick look at what is coming next in our upcoming module. We will be moving from basic policies into advanced asset valuations and critical corporate calculation frameworks. We will explore as 13 to understand how companies value and carry short-term and long-term investments like stocks and bonds on their books. Then, we will tackle as 20, where you will learn how to calculate earnings per share, master denominator weighting rules, and analyze dilutive corporate instruments. Finally, we will break down as 3 to study cash flow statements, learning how to separate an enterprise's cash into operating, investing, and financing activities. Review your notes for today, and I will see you all next time. That brings our Frameworks and Principles module to a complete close. Thank you to each and every one of you for your dedicated focus. If this session helped, please take a quick second to hit that like button, share this lecture with your fellow MBA or business classmates, and click subscribe to our channel, Common Center.